This conference will now be recorded.
Hi, I'm Patrick Reed from the Adamus Principle. It's Sunday night, and those who've been watching our posts on LinkedIn, don't worry, Beat and I are not. We're still friends. We haven't fallen out about retail sales in the US. It's what maketh the market. You get buyers, you get sellers. I interpret the market the best way I can on my experience, but sometimes I'm wrong, and sometimes I feel like I'm always wrong, actually. But that's the joy of an open and disruptive discussion and healthy argument. Because sometimes I'll get to I'll get on my soapbox. I'll say, look, no, this is it, this is that, and then I realise that right at the end, I'll be like, maybe I'm wrong. But we'll come to that, and that's all good. We'll come to that. Beat, you're in the house.
I'm
You're the
in the
calming
house.
influence
I'm
on
in the house indeed.
viewers.
Hi,
How are you?
Patrick. Not too bad yourself?
I'm very well. I'm a bit shocked about this retail sales, but we'll come to that. We'll come to that. Um, these are mints, by the way. They're nothing more strong. I don't need sleeping tablets. Or uppers or whatever. Yeah. So anyway, let's kick off. I've got a few slides. You can see this. It's the dollar index. Can you see that, Pete?
Yeah.
Okay. I did a post on Friday, or was it Saturday? I can't remember. I did a post, and I got quite good response, and I got some personal messages from some pretty big people actually, and everyone's in agreement. A couple of agencies I spoke to are in agreement as well. Trading FX is very, very difficult, and you only have to look at the dollar index to agree, because this is the daily chart, it just doesn't know what it wants. It's the bars are just all chopping everywhere, and it's just been an absolute nightmare to trade. If that wasn't bad enough, risk plays, right? Yen pairs. It's been an absolute nightmare as well. So you've got a choppy dollar and choppy risk, and you've got different flip-flopping messages from various central banks. I'm not sure it can get any more difficult than that. So I thought I just want to take a step back, look at the US macro picture again, and then we can start discussing what's happened in the last week. Obviously, the big one was retail sales, and we just take it from there. So if you bear with me, I'm going to go through some slides. Okay. So this is something we do, making sense of macro. Just got a few slides. Again, just take another look at the dollar index. Absolute nightmare to trade. So we'll come back to that, and we'll thread that through the webinar. But just to let you know, this is real GDP. This is really the engine of the US. Look how big it is. I mean, it's what, 3.2, 3.3 off Q2, but still pretty damn good. And if you compare that, this is real GDP, sorry. If you compare that to the rest of the year, we're still higher than 2017. We're still higher, way higher than 2016, and we're neck and neck with Q1 and Q2 2015. So not really worried about that. What are your thoughts on that, Beat?
To be honest, I was actually just logging into some of my systems here to see there was a news out late Friday from one of the Fed, the local Feds that come with their sort of running GDP expectation.
Yeah.
I've seen as well, let's say some of the banks, one of which I saw was Barclays, took their GDP, Q1 GDP down to 2.1% from 2.8 after the retail sales. I just maybe have the other news here from the regional Fed, which was kind of pointing the same way. So it starts to look as if the early 29 GDP is actually coming off.
Okay.
Here we have the US New York Fed GDP now cost Q4 is now runs, they run it at 2.23% for Q4. Sorry, I meant Q4, not Q1. And
Okay.
some of the banks took it down from 2.8 to 2.1. So still on overall average, not too bad, but I think you alluded to it. And the way the market reacted after the retail sales was a clear shock, you know, in, or maybe we have to see it in context with all the recent lower GDP across the world. So I think it was more the sort of instant knee jerk about, oh wow, you know, has the slowdown finally knocked on the door in the US? And to be honest, I was blogging about it, and I was on the investing channel talking about it as well. And yes, we can't take one number and say, you know, it's all bad, whatever. But, you know, it's a first number that really, really had a strong downside surprise. It was the biggest month-on-month drop since 2009. And that is obviously when people hear that, they go like, you know, like, whoa, you know, the moment you hear anywhere near 08, 09, people have a little bit of a trauma. And so I think, to be honest, it didn't last very long before, you know, I think, you know, the next day we already forgotten about it. Stocks are excited about Trump's China deal again, and everything seems to be forgotten at least until the next set of data. But, you know, I think we have to watch it carefully now. You know, is it really just an accident? Some did suggest it's been related to the government shutdown. I then read quite a few reports that said it was not.
Yeah.
So that the customers did respond to the questions. We still, I think we still one behind in retail sales. I think we had like December, we still should, I think we still owed another retail sales, which wasn't released because of the government shutdown. So, you know, we're going to be watching that. I mean, we have to see an improvement to what we've seen. Otherwise, I wouldn't blame the market actually taking the view, you know what? Now we know why the Fed has gone silent. Now we know why this is happening. So the Fed has actual evidence that the slowdown has finally reached the US shores, which, to be honest, like we say, you know, one swallow doesn't make a summer, one bad number doesn't make a recession, right? So we have to be careful. And the market has it, you know, ignored it. Dow quickly dropped, dollar quickly dropped. Fast forward a day, no one cares. So, you know, it's another flip flop, so to speak. So I think for the time being, as you pointed out, let's say we are, well, Strachey would say, cautiously optimistic.
Yeah.
Right.
Yeah.
So,
I agree. I mean, I just with you know, for me it was all about dollar yen, and you know, I think we were sneaking up above 111, just 111.20s, and then we got hit. For me, 110, the big figure, the line in the sand, and that's held so far. I think the lows were 25s or something. So, you know, we're just consolidating around there. I've got a few bids down near that big figure, and I just think if that breaks, then that could kind of, you know, one view is going to win out, because to me, before retail sales came out, and I shouldn't be saying this, but I'm going to, there were Fed put buyers of risk,
yeah,
and that's just my gut instinct. I just think there's enough in that. I've seen a lot of signs to say the market tastes risk, it wants risk.
yeah,
And if nothing's going to come out to spoil the party, then thank you very much.
yeah,
And these people, maybe they won't admit it, or they're not 100% in belief, but secretly they think there's a good chance of the Fed put. So, you know, we are off the highs on dollar yen, because that was the big move for retail sales, wasn't it?
yeah,
You know, so let's just see. I think dollar yen is a good currency pair now to use as a metric for the data in the US. I think that's what I'm using anyway. So that's great, Beat. Just another slide here. CPI. I mean, the blue line, which is headline, that's oil, obviously. But interestingly, core is just steady as a rock.
Yeah.
If you ask me, if I saw this chart, I always look at these charts. These are from public sites, obviously. If I saw this chart, would I be really, really worried? If I didn't know anything about oil, then I'd be a little bit concerned. But because of oil and where it's gone, I mean, it's off its lows now, but I wouldn't be. And the bottom line is the Fed looks at core anyway. What are your thoughts? You got anything to chip in on that one?
To be honest, I was very surprised that core. I wasn't surprised last time that core would stay up. This time, I actually would have thought it can actually manage to come off somewhat, given the sort of drop in headline CPI we expected. So if I look at the chart, so my sort of, like I did comment something over the weekend on LinkedIn about correlation, or let's say overlay charts. You sort of try to read in one thing, but the blue line could bounce as well. Otherwise, I would say the red has to come off, right? Eventually, if core CPI stays down, then that factor has to somehow come into the core at some point in time, because they usually don't diverge for too long.
Yeah.
As you pointed out, oil started to bounce, so maybe it's actually that the headline starts to stabilize, pops a little bit higher, and core just stays flat. But the divergence usually, we don't have much history on it, and I don't have a chart either to look at it. But the divergence usually, you can't have headline keep on coming off and core just staying flat. So either at some point headline is going to bounce, or core has to actually cave in. I think the key on core will really be whether what we just discussed on retail sales, whether data is cooling off or not. So if the data is cooling off, then you will see core CPI probably indeed start to come off. But it's very hard to take the temperature. So we have wages still going up, we have overall data still okay. We had one hiccup now, and we have a few weaker number ISM and some of these other components. But at some point, I mean, reality is that the US comes out of a fantastic cycle, hitting the snag with the trade war with China, because some areas in the US are actually suffering with the trade war going on, and you have the rest of the world slowing down. So can the US really be that island? I would doubt it a little bit. So whether we actually see that all that we've seen around the world is just a hiccup, a correction, a little bit extended of the weakness, but generally coming back, it might work. But if I look at Euro data, if I look at some of the other data around the world, you just wonder what is a time lag for it to actually hit the US, rather than it's more about when, not if. But this is it's been an unbelievable cycle. It's and with the whole sort of risk side of it, with equities and so on, it's a really tough read. But one thing I would say is that this time, the Fed put will not work the way we kind of would expect it to work, because I still think equities are inflated, still post QE inflated. We still had a lot of stock buybacks that pushed the price up in 2018 in equities from the tax cuts, which is going to be gone. And a lot of these sort of, I saw a chart someone sent that around, the S&P versus expected earnings. where the earnings just took like a big dive, like the forward-looking earnings. So there is evidence. Oh, the chart I showed in my interview is Investing Channel, Baltic Dry Index versus S&P. Right, with the Baltic Dry Index being like a 2 months lead versus the economy until it really hits into data. So I see evidence that are maybe still a few weeks away that are actually pointing quite a grim picture, even for the US. And so I'm not bearish, and that doesn't make me bearish the dollar, because it's still the best of the rest, which I think is why the dollar has survived the dovish Fed or the neutral Fed, whatever you want to call it. It has survived. You know, it basically chucked a lot at the dollar in the last few weeks, and it survived. Why? Because people look around and go, like, you know what, do I want to buy euro? No, I don't. Do I want to buy? No, I don't. And so really what we have to be careful, and I think I say this for the dollar bears, because I know there are quite a few dollar bears out there. There is a time lag. You might be right in the later part of 2019, but be careful. You could get a dollar default rally in the next few weeks, months, you know, where actually there's nothing else to buy. And you know what? If you look at dollar yields versus euro yields, you know, what do you buy? What do you buy? You know, with all the problems that are coming on Europe now in the Q1 and early Q2, with Brexit, Spanish election, European Parliament election, the whole yellow, you name it, next to all the weak data as well, of course. And so really, that's why, you know, the only reason the euro isn't a lot lower yet is probably because we had a bit of weaker US data, a bit of Fed, a bit of this. Because otherwise, we probably would already be on a 111 handle, possibly, or lower. So the only thing that we haven't done is sold off in the euro. But I cannot see euro rally more than, you know, the odd quick accident at 113.5, 113.80 or whatever. But there's just no reason whatsoever to buy euros. So even if the US will start to cool off, it doesn't make me dollar bearish, fun enough. You know, right? And that's why, you know, how important, of course it's important to watch a US, but I don't think we get an FX trade from it right now, other than a little bit of noise on the day when the data is out, similar to what we had in with retail sales. So there's more short-term trading opportunities with US data than there is macro trades, I think. That's what I'm probably trying to say.
So gun to your head, does headline converge with core, or is it the other way around?
I would actually think, in terms of where we are in the cycle, I actually think core is going to come up.
Okay, I disagree. I think headline's going to come up to core because of oil. I think there's enough lag, and the thing that really nails my conviction on this is wages at 3.2. I think people have more money, and I think they'll be spending lots of other things other than retail.
Yeah.
And I just think there's a whole load of other stuff they'll be buying. So that would be stabilizing core. And obviously, if we get a bit of a bounce on oil, I think headline will recover.
I mean, your odds are definitely better than mine. I'll give you that.
Oh, I don't know about that. I make half of it up. Okay, so the final slide before we quickly move on. Employment and total non-farm payrolls. This is interesting because the last print was a blistering 304. However, wages were it was 3.2. It was kind of in line. Month on month was down, I think, but the red line is the annual average. Nothing wrong there if you're looking at throughout the years, really, is there? What do you reckon, Beat?
Yeah, to be honest, I think the US has full employment. This is really not the one thing that really concerns me at this point in time. And even if the next data should be a slightly weaker one, what the chart nicely shows, we just err. You know, that's why I keep on saying since probably about more than a year that non-farm payroll is just not important anymore. It's noise. For the time being, even unemployment, if it's 3.9, 4.1, It doesn't matter. It's full
Yeah.
employment. So we do not get anything from that number in terms of Federal Reserve policy. We don't get anything else. Then, yes, once we print below the average for a few consecutive months, different story. Then I will start to watch it. But as long as what is the average around 220, 200-ish? Yeah, it's hard to see. Probably around 220. So as long as we get 150, next time we get 300, it's just no story. So really on non-farm day, the only thing the two of us really watch is average earnings. That's really the interesting one. And the US, as the chart shows, the US has actually full employment for quite some time now. So it's just not a story. It's not going to go away. And it doesn't mean the Fed is going to do anything. The Fed actually doesn't have to do anything. They hiked rates for this scenario for 8 times already. So there's not, if we start to print 300, we don't drop below 300K anymore. Different story. But even that I don't see. So I just think it's not a story anymore right now.
So that's fantastic. Just as a final wrap, these sort of charts I'm showing you, we're sort of showing you, I use to have a look and say, is everything ticking along all right? Yes, great. Nothing's really changed my macro view in the US. We've got some nuances. We've got a few things that are flagging up, like retail sales and stuff like that. But all in all, this is just always good, especially if you look at the averages throughout the years, because these charts are on the kind of the websites that the Fed looks at, basically. They're the stats. That's what the Fed looks at, basically. So that's it for the sort of US macro picture. I'm just going to go into charts as we sort of go into the other stuff. Finally, we've got about 10 minutes left, so unfortunately we're going to have to sort of wrap this up. Finally, risk trading. I mean, obviously you saw the dollar index. It's a nightmare to trade. It's been really difficult. Now we're going to talk about risk. Now, I kind of, when I get confused in a trade, when I don't know my head from my elbow, I was going to say something else then.
Yeah, I too. I was worried.
Yeah. I just look for technicals. I started as a technical trader, and I just look for breakouts. And dollar yen for me is looking really interesting because it broke 110, and I'm looking to be buying into that. That's just me. It's just my thing, and we're holding above it. We closed above it. We're holding above it, and I just think sometimes the risk pairs are really difficult to trade. You've got a lot of uncertainty out there. So I think what I'm doing is just trying to look at price action and the technicals. I don't know how your view is on that, Pete.
Yeah, to be honest, I mean, right now we have no other choice than sort of using the charts to just try to pinpoint the sort of key levels that we think either if you're a risk bear, you're prepared to fight the risk, or if you're a risk bull, you're trying to use the dips to kind of buy a risk. Like you said earlier, I think before we came online, the problem is really the flip-flop. So one thing, and this is something I always appreciate and be careful about in my trading, the market obviously wants to buy a risk.
Yes.
Why? Who knows? We shall see. But the market, even after we had this dip after retail sales, then there was like one comment from the White House that sounded a bit bullish on China, and stocks are just rallying back very hard. So the market wants this, and so that means that a rally can actually last a little bit longer than we would expect from the news, because the news itself, to be honest, I truly believe we're gonna get a partial trade deal, not a full trade deal. I think this intellectual property rights, as well as the reciprocal access to the economies, it's not going to happen. China is not going to change the business model, nor are they going to change the economic model. But I think people kind of realize that those discussions will be the sticking point. I think that's where they're struggling at the moment. And the interesting part will be to see what the market is doing with a partial trade deal. Economically, they probably care more about the partial one because it's going to include, the auto tariffs go disappear, the Chinese are going to buy whatever in the US agricultural sector. So economically, I think it will be it will help. How much this intellectual property rights, for the tech sector, for Huawei, Apple, and so on, what's that's going to do? I don't know. I'm not the expert, to be honest. But so we're not going to go all the way on this trade deal, I feel. And one thing which I usually don't do is I just want to see what's happening when the news comes out. I learn more about the price section
Mm.
than I do. So rather than, yes, of course, I have my certain levels where I go like, that's the area where the risk reward is a lot better to, put money where mouse is in terms of risk off. But what I learned the most is, so let's say, for argument's sake, tomorrow is a trade announcement. We have a trade deal, blah, 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 blah. Okay, I want to see the Dow go up at least 500 points minimum and hold. And then the next day, I want to see another 250 points on top of it. That's when I back off and go like, okay, maybe I'm just wrong. If I see the Dow rallying 250 points and then closes 150 up, I will immediately sell risk because then I have to buy room and sell the fact is actually happening. So for me, rather than preempt, because you know what, this story has been going on for so long, and there's actually still the risk that it's going to go, that the deadline is going to be shifted for 60 days, which I just hope that it doesn't happen because
Well,
it
the
means.
market likes that idea, doesn't it?
Yeah, the problem we have is the 60 days is we have another 60 days of flip-flop. And I'll be honest with you, Brexit flip-flop is already enough.
That goes back to the market wanting risk because any kind of can kicking,
Yeah,
and say this thing about Brexit, if they delay any kind of Article 50, then the market cable's just going to get lifted.
yeah,
So
I
I
agree.
just think certainly I don't know what your views, but equities lead yen pairs at the moment.
Yeah.
And would you prefer Dow to S&P to be the
Um,
first equity index to lead risk?
to be honest, I actually have a cynical way of watching it. I watch S&P futures during when the cash isn't open, and I worked when I was at Goldman. I worked with a very smart man. Well, there were a lot of smart men there anyway, but he sometimes just said, S&P futures, S&P would go mad, whatever, and he said, let's wait for the real boys to come in when the Dow cash opens. And very often you see, that's where the real stuff is happening. So I actually got used to watching the Dow when the Dow is open, the cash, and I watch
Yeah.
S&P in the off hours.
Okay.
But this is personal preference in terms of but I sort of, since this was about 10 years ago, and very often, let's say we had S&P futures under pressure, 330 comes along, I stop everything, I watch the Dow open, and the Dow pushes to the opposite to the S&P futures when the real boys come in. So S&P futures to me is a bit like the euro dollar traders. Everyone is hacking around on it, and on Wall Street it feels more true in the nature of the flow, the more honest flows. But to be honest, maybe equity guys who listen can add some feedback on our when you put the
That'd
link
be
up.
great.
Maybe I'm looking at that wrong, but personally, I think no matter what you watch, if you're comfortable over time that it works for you, that it worked for me. So that's just how I kind of look at it. That the Dow gives me what I feel the more honest moves actually.
That's great. Well, we're going to sort of wrap that up now, mate. I've gone through some of the charts, but not much going on next week apart from PMIs in Europe on Thursday. And we got a lot of Fed speakers, as you know, but we'll both be commenting on LinkedIn throughout the week. and just watch that risk. Before we go, I've been a huge fan of Beat's commentary, and you know, it's he puts a ton of work into it. It absolutely the best in town. And Beat, would you like to say a bit more about that?
Yeah, thanks very much, Patrick. Actually, I thought about this. Today, I do something new. So today, I tell you my website, which is www.macrobeat.co.uk. It's actually just have a look in there. I'm blogging there as well. Have a look and what you see, and there is a little green button there that would just connect you with me, where you can get a 1 week free trial. Have a look. I'm happy to accommodate that for you to make your own minds up. Appreciate the feedback from Patrick, and it's always good to know if what I produce is liked. But I invite everyone to come in and have a look.
And for that, that's fantastic, Beat. And for those who missed that, I'll be posting the website address on my feed, and that will be on the Making Sense of Macro webinar when that gets posted later this evening. And I really do encourage you to have a free trial. Beat, as you know, he's sat in some very big seats: Goldman's Prop, UBS Spot, Commerce Bank, you know, Morgan Stanley. He's done it all. He's been there. He's done it, and he's not only done it, but he's done it in a crisis. He's seen some, you know, 98, you know, particular year, but other days when the sky's falling in, and he's been on that seat. So again, just give it a go, and it's great, and that's it from me. So I'm just gonna wrap that. Is there anything else you want to say, B?
No, I think that's really all set, and waiting for a new week.
Great. Well, watch that risk, and you know, take care, and this yeah, have a really good trading week.
Have a lovely week as well. All the best to everyone.
Cheers, B. Bye.
Good night.